Welcome back to Rockstock Channel. It is Sunday, February 18th, Monday morning, Perth time. We have as a guest Ron Mitchell from Global Lithium. Not so much about Global Lithium, but just as a veteran of the industry, having been through multiple cycles in a prior job at Tangxi and very connected to what's happening in China. We thought this is a Rockstock recap, not so much a video or a vodcast. Not that you guys care so much about that distinction. I just want to highlight, we published, I think, forget exactly the number, 91, I think issue number 91 of the Lithium-ion Bull. Lithium-ion Bull has been a newsletter I published. It's kind of how I got my start before the podcast and the video in 2017 was, I think, issue number 1. We're now 7 years into that. I labeled this one One Love for Bob Marley and Enter the Dragon for Bruce Lee. Both Bob Marley and Bruce Lee died prematurely, but I did not make that reference in the Lithium Bull about the lithium market dying prematurely, but probably should reference, like Mark Twain, rumors of the demise of lithium, are premature. But I do have behind me, as I've flagged before, Three Little Birds song here. Don't worry, because every little thing is going to be all right. That's also the ringtone on my phone. But for all you listeners, if you don't already get emailed directly into your email box, the Lithium-ion Bull, I'd encourage you to visit our website at rkequity.com and register your email there. And also, if you like these videos, please like and subscribe, and visit Rodney and me on X at Lithium-ion Bull, and at Rodney Hooper 13, and on patreon.com/Rockstock Channel. In the Lithium Bull, we talked a bit about leading indicator CATL. We just had the Albemarle results come out, and Albemarle has been not a great predictor of the lithium and navigator of the lithium market. We're calling this Rockstock recap a lithium squeeze box because it does seem that there's a short squeeze underway. We called a video last year a lithium squeeze box when Albemarle bid for Liontown in April. There was a recovery in the stocks then, but to look back and think 6 months later they were exiting, and what's happened in the market, just like how could Albemarle misread this market, so much. So we speak to Ron, as we've spoken, we've had 5 meetings, like this, Zoom calls per day, for the last kind of 4 or 5 weeks. And one analyst that I spoke to in Perth was basically, and I agree with him, listening as we do to all the lithium incumbents is one thing, but we think it's actually more important to listen to CATL, and LG Chem and LG Energy Solutions and Panasonic and their conference calls, because they're the purchasers of lithium and they have a bit more knowledge about what's going on. CATL, I didn't realize until I wrote this Lithium Bull, just market timing wise, just for all, I'm just kicking myself. CATL sold their Pilbara stock at $4.10 in March of 2023. Shares, which they bought 4.9%, they bought, a few years ago at 30 cents. So that was a leading indicator. We should have all just sold our lithium shares when CATL was sharing. So, but CATL stock, as many lithium stocks have, as a lot of Chinese stocks have not done well. China market broadly, I think, are at 5-year lows. It was on the cover of The Economist, how badly the Chinese stock market has been going. And that could be viewed as a contrarian indicator. There is that kind of magazine contrarian indicator. If it's on the front page, then, it's there for a turn. But look, the stocks are going up. We have suggested, we're approaching the point of peak pessimism. We don't know, but a lot of people were thinking that after the Chinese New Year holiday, everyone would be coming back and, buying lithium and other activity. So there was a Bloomberg article talking about that travel in China, was very, very strong. And that there was a feeling that the Chinese economy was going to do, quite a bit better, and maybe the stock market and maybe the lithium purchasing. So we shall see. Enter the dragon. Here we are. And lepidolite it was all over Twitter, in the last, kind of couple of days, especially CATL's I don't know how to pronounce it, Zhangzhuo mine was seemingly on care and maintenance or, slowed down. SMM said so in November, but there were further rumors now that it's been like shut down. But UBS, Joras Hartley's, and a whole bunch of other people, I don't know who originated this rumor, but it's gone all over the place. And as we speak, the market is rallying a little bit, not hugely, some stocks more than others, but we definitely want to talk about lepidolite. There's also some news in Australia this week about prospective support for the lithium industry and the nickel industry. Ron can speak about that. In Canada, there was talk about reducing permitting times. So good progress there, potentially, for the Canadian story. There were very good, China sales, exports, all good. We had Albemarle's results, which we could talk about a little bit. They ratcheted down their 2030, estimates for demand from 3.7 to 3.3 million. The first time they've done that in 4 years, but nevertheless, for 2024, 2025, very strong. And we think they're severely underestimating grid storage in their 2030 numbers. So we'll talk a little bit about that. Stellantis, Mercedes announced big news, in Europe. GM, LG Energy Solutions, big cathode deal, $19 billion. GM and Panasonic are investing in Lithium-ion. A lot of positives, some negatives. The USA is talking about delaying, political pressure from the UAW and the Biden administration. So there's rumors there that they're going to go slow. There's further rumors that they're not only going to put high tariffs that, on Chinese imports, from Mexico and elsewhere, but on national security grounds, they may not allow Chinese cars into America, because, battery or whatever, China will be watching, American drivers. So USA is negative. Lithium has historically been very much a China dominated theme. We've talked about it. It is very much, a China dominated, theme again, even if the US, does go slow. We just got to focus on what's going on in China. Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video. So with that very long lead in, Ron, you were most recently at the RIU conference in Australia. So I don't know very much about that conference, but we saw a lot on Twitter, a lot of companies sharing video and, just written, PowerPoint presentations. If you could just give us, a sense of what happened there. And also we spoke to you last week or 2 weeks ago about a whole host of things, African spot, China lepidolite. You were recently in China visiting with some of your customers and future customers. So it'd be really good to hear what you're hearing about where we are and where we're going in the near and medium term.
Yeah, sure, Howard. Thanks for having me on. Yeah, the RAU conference, the Explorers Conference, held by Vertical Events, is probably one of the preeminent conferences here in Australia. It was really significant attendance. I think it was more than 2,000 delegates, and a number of, explorer and developer stage projects presenting with exhibition booths. So the real theme of the conference, a lot of lithium players, obviously ASX listed lithium players, and I think the general mood of the event was quite positive, in spite of, quite a significant sell-off on the equities and obviously the lithium price coming off quite significantly. But I think the reality is now, and again, these conversations were echoed in informal presentations by a number of, our peer group. And the general view was that we're at or through the floor as far as spodumene pricing is concerned. Now, look, I've been through this cycle. This is the third cycle I've been through in terms of lithium pricing. And I think what makes this one really interesting is we've seen an all-time high of, in terms of spodumene pricing, over $8,000 a ton. And we've seen the price sort of crash through $1,000 a ton, all within sort of 24 months. So I think that's got a lot of first-time investors a little bit spooked. But what's different this time around, clearly, is that the buying hasn't stopped. That's what did happen in 2018, 19. Quite simply, the buying just stopped. There were contracts that they weren't executed. So importantly now, the buying's continuing. It's just a question of price. So it is different from that perspective. But also, how if you think about pricing cycles, typically when prices do come off, the market will track sideways for a period of time. And that's exactly what we're experiencing. It's very similar to the previous cycles. What I can say in terms of my personal experience and with the lithium price cycles is we've been in a bear market now for well over 12 months. You think the pricing has been ratcheting down since really Q4 of 2022. And it just so happened that sort of through the early part of this year, the price has moved down below $1,000 a ton. So my expectation is that, as you rightfully said, when those purchasing managers in China do return to their offices, and my view is that inventory positions are low. It's not just through a single source; it's through multiple sources within the value chain. The typical procurement strategy is to maintain, 2 to 3 months of inventory through the value chain. What we've seen over the last sort of six to 12 months is that strategy is being adjusted, and it's really been hand to mouth. So what that means is when the market does turn from a pricing perspective, consider we're at or below the floor, is that, we can expect a level of buying. Now, the question is, how long will the market track sideways? That's really the only question we need to consider here. Is it 3 months? Is it 6 months? Is it 9 months? My view, it'll be sooner than later. I think we've seen a number of announcements, and certainly the REU conference, a number of announcements around supply side discipline. And I think the incumbents in the next round of quarterly reporting will indicate that as well. So Talison's another company that has announced a curtailment, certainly in terms of production. So we're seeing less units going into the market. You're right. You commented on CATL earlier. Whether has been substantiated or not, I can't say, but certainly the rumour mill is swirling with regards to a significant curtailment in terms of lepidolite production in China, and also the downstream tolling of that material. So that all bodes well in terms of the general view by the market is that we are at or below the floor. And what we've seen in previous price cycles, the price will typically overshoot on the upside. It's exactly what we saw in Q4 of 2022. The rest of the market was probably buying lithium, most of their lithium, somewhere between $5,000 and $6,000 a ton, but the spot price went up past $8,000. And typically what we're seeing at the moment is that, you've got a single index reporting a spodumene price below $1,000, but most of the deals are not being done at that particular spot price. It's typically a basket of prices that makes up the contract price for the incumbents. So there's a lot to unpack there. But bear in mind, as with all major transformations in the energy industry, this is exactly what we're experiencing. The market will not develop overnight. It takes a number of years and ultimately a number of decades, and that's the energy transition future that we're currently experiencing. So I'm not at all surprised that we've seen this correction. In many ways, I think it's actually a good thing. We'll look back in a few years and it's probably the shakeout the industry needed to happen, call it the lithium recession. The industry needed to happen to shake out some of the projects that really were just sucking in capital, had no intention of being developed, and that was a frustration. But what we'll see now with this price correction is that the projects that are legitimate, that have legitimate experienced management teams and are located in good jurisdictions, they're the projects that will get the investor focus going forward.
Ron, what we've been struggling with here is reading bank and broker reports where they have an expectation of increased supply from lepidolite and some of the lower grade stuff and what have you coming out of Africa. Mm-hmm. And fundamentally, I'm struggling to get my head around how it is that a 0.25, 0.3% grade operation can stay afloat and, 1% plus spodumene can't. It just, especially when you look at waste disposal and all those other things. Now we're hearing a talk. To be honest, from my perspective, I don't believe that $13,000 a ton is still high enough for that particular mine to keep operating. Your thoughts, how is it conceivable that lepidolite could potentially double its production, even if it was planned and ramped? We know that on the spodumene side, people are going to delay, I think. So how is it possible, given the costs and costs in China have also gone up. If you look at wage costs and so on, how those operations could potentially stay in business and grow around current levels.
Yeah, it's a good point you raise. And I think the experience globally in the lithium sector, whether that's operational, development, exploration, and then on the analysis side from the investment banks, I think it's limited. Rodney, I know you've been commenting on the sector very intelligently over a number of years, and I think there's just a lack of appreciation of firstly, how hard it is to get quality projects up and going. And then secondly, you're right, it comes down to pure economics at the end of the day. You've got a resource grading at 0.2 to 0.3, if you're lucky, 0.4% for the better projects in terms of lepidolite. How these projects can be competitive with spodumene, which we all know results in high recoveries from a flow sheet perspective. So it simply doesn't stack up. And I think the expectation that, there's going to be these hundreds of thousands of tons on an LC basis delivered to market from that particular source of lithium mineralization is hopeful at best. So I think time will tell clearly. I think there's better education in the market now, certainly more sophistication in terms of the quality of the questions that have been asked through the value chain. And I think, if what's being reported is actually true, in terms of, the China lepidolite story, it'll be a really interesting one to watch. But again, it gets back to those projects that have the best cost profile. And you also need to consider how to deal with the residue. That is a fundamental question, which still hasn't been answered in my view. They're the projects that are going to lead the way in terms of new supply to market going forward.
Absolutely. And then when we look at it, where we do agree with the analysis across the industry is that demand is in a fairly tight band. There could be, a couple of surprises, but invariably, if you accept that there's going to be some kind of an easing of interest rates this year, there are some new products coming online. China will push for exports, in my opinion, this year really hard. I think that number could possibly double from 1 million to 2 this year. EVs out of China. But naturally domestic. And then, grid storage, if battery cell prices drop off, that could, if $50 a kilowatt hour is really a number that will incentivize, I think, a lot of backup storage. But in general, demand everyone seems to have a reasonable handle on that. We think it's supply, but adjustment that drives the price better through the year. So, in your mind, are there any sort of considerations like, contracts in place and so on that make existing operations important to keep going, even if they are touch and go, because there's contractual obligations, there can be backward integration, there can be lots of things. We're in the bizarre position that it is, Talison Greenbushes that's the highest grade and one of the lowest costs that's easing back, but that makes sense. Your thoughts on possible other supply adjustments? We've discussed lepidolite, other ones.
Yeah, good question. And you're right. I do certainly agree with you. It's probably the sentiment on the supply side that's really driving the equities and commodity price at the moment. I think you're right. When you get a price downturn, and we've seen this in previous cycles, the incumbent producers and also the developers are going to be obviously watching the market incredibly closely, and they're not going to be willing to turn the tap back on in terms of either growth projects or spending significant amounts of capital to progress a project from a development perspective until such time as they see sustained improvement in pricing. It's as simple as that. It's not a case where, okay, the price goes up, 10%, 15% over the next month or two. The market is going to be requiring a sustained improvement in price to demonstrate that, yes, we're back in a bull market. Now, whether that's 4 months, 5 months, 6 months is going to depend on each entity, but certainly we're in a bit of a conservative, more disciplined period at the moment in terms of how companies are spending cash and looking at projects. And there's definitely going to be pullback in terms of development. So what that means is when the price does rebound, it's going to take longer in most instances for projects to restart. Now, what the incumbents do in terms of managing existing contractual positions, certainly those that have got offtakes, are going to, for the most part, be looking to fulfill those offtake positions. But what I have experienced in the past, where there's market pullback, obviously the terms of those offtakes are typically revised as well, either the quantum of the material to be delivered or the pricing scenario. What you can probably expect is a combination of those, maybe a slight adjustment to the quantum in terms of quarterly deliveries, but also maybe the pricing, because no one's going to be selling below their production cost on a sustained basis. Even, most of the Western companies could tolerate that for a month or two, but certainly are not going to be willing to tolerate that in the longer term.
And Ron, what do you think in your mind, where is incentive pricing for this market to see development? Because we think it's quite a bit higher than where we are now.
Yeah, again, I don't think a lot of people truly understand what a cash cost versus incentive price actually is. They're two very different things. So if you think about the amount of capital required to develop a new project, and it's not just the project, it's the infrastructure to be able to get that mine to market effectively. And if you think about the location of some of these development propositions globally, there is quite a significant amount of infrastructure, pre-development infrastructure that's required to be built to be able to, bring that material through a port, for example, and then into a global value chain. So I think incentive pricing, my view is being reasonably conservative, probably is going to sit somewhere between 1,500 and 2,000 a tonne, depending on the jurisdiction.
We would agree with that. If you look at, especially where cost inflation has run to, that's a reality we face.
Mm-hmm.
But if you think about it though, Ron, if we tie that across the full industry, 1,500 to 2,000 translated into a downstream chemical price is still very acceptable in the battery supply chain in terms of where that leaves you with sell prices and the industry remaining competitive.
Mm.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com. Albemarle had a sensitivity analysis between 15,000 and 25,000. What on 25,000, what does that translate into the spodumene price, Rodney?
On a break even, but what I'm saying is, you can have 2,000 for spodumene, on a CIF basis, and then add the costs onto that, and you're still coming out at below 25 without a margin. In my opinion,
Great.
anything sub $30,000 a ton leaves the EV industry competitive. Ron, would you agree with that number?
I would agree 100%. There needs to be margins through the entire value chain. I think obviously clearly when pricing's at, $80,000 US a ton, that just is completely distortional. And that's what we saw. It wasn't, it clearly encouraged every project to come into the game. And this is what we saw, a response by way of supply last year, but prices are managed somewhere between 1,500 and 2,000. Yeah, enough projects get up for the market to be sustainable and profitable, but it's not, the pricing in that sort of range is not going to encourage too many projects, and hence we get a big oversupply and a price correction. So I think the market is still evolving. That's what I guess your listeners need to understand. The lithium market is still very much evolving, becoming more sophisticated. And I think this, as I said, this lithium recession, call it what you will, ultimately is exactly what the market needed.
Yeah, we certainly, Howard and I, on the scoreboard, we've catapulted to hundreds of projects now, and you mentioned it earlier. Everyone drawing money out the system. You know, we've seen and spoken to people who gave off on other metals projects because they just weren't raising money where lithium was attracting, and that kind of saw a lot of companies sort of pivot, I guess.
You saw exploration dollars. There hasn't been a lot of dollars that have gone to projects that shouldn't have gotten funded, though. I'm not sure I fully agree with you, Ryan. Like, I didn't need this recession. And most investors didn't need it. Like, the price could have gone down to 1,200, like, or 1,500, and not caused this now, because Albemarle is slowing down spend. We'll see what Arcadium is going to announce later this week. You know, others are slowing down, and that's just going to set up the cycle for another overshoot, you know, on the upside. So you're right. The market is evolving. It's still very immature. Like, I've actually looked at iron ore, you know, and oil, and, you know, those prices are volatile also, but iron ore going from like 50 to 200, right? That was extreme. That's a 4-time increase, but most of the time it's going between, you know, 80 and 150, right? So that band. Or oil goes from 60 to 120, but it's not so crazy. But for lithium to go from 4,000 to 80,000, you know, back down to 13,000, that is representative of a very immature market still. A very small market where I remember, Rodney, in some of our first podcast, you were talking about like just a swing of 10 or 15,000 tons either way, you know, can vastly increase, you know, the price or decrease the price, you know, of lithium. And we're seeing that here. I put in the Lithium Bull. I want to thank, you know, Evan Cranston, who, you know, flagged this on Twitter. He just showed the JP Morgan report. And he just took it like, so they build a very sophisticated supply model, but in that supply model, they had Sigma Lithium, right? Sigma Lithium, which announced stage 2 and stage 3. JP Morgan was basically saying there's going to be a 37,000 ton surplus this year. But in their model was that stage 2 and stage 3 were going to be producing this year. And Sigma just announced last week that they have an MOU for funding just for stage 2, not for stage 2 and 3, right? So the likelihood that supply, stage 3 is not coming on stream. Stage 2 is unlikely if they don't even have the loan for that. And then we had Dwayne Sparks, you know, who's writing very popular tweets about lepidolite. Today tweeted about the difference between 5.5% spodumene and 6% spodumene. So a lot of, you know, JP Morgan and others have in their forecasts, you know, the PFS or the DFS from Sigma, which says 250,000 tons of SC6, you know, is going to translate into, I don't know, 36,000 tons, you know, for stage 1, right? But if they're producing at 5.5%, right, that material is much worse in the converter. So the converter's recoveries are much lower. So it's actually going to translate into less than 36,000 tons. He didn't say, like, couldn't estimate how much, but it's going to be less. But the models say it's going to be what it says in the feasibility study. So there's a lot of scope for supply not to be as large as predicted. And I just thought that was useful. One of the things you mentioned in our call a couple of weeks ago is just the quality of African supply, right? There was a lot, you know, the work that was done. And just so, like, we understand in Zimbabwe, there's Bikita, there's Sabi Star. These are legitimate mines that have been in operation. They've done a lot of work, but a lot of the other material coming out of Zimbabwe and other places doesn't seem to have gone through a 3, 4, 5 year, you know, progression that a typical Western Australian mine would go through. And that has resulted in what in the marketplace, Ron?
Oh, you'd have to argue, general pullback. Pricing is the key driver to, you know, expenditure throughout the value chain, whether it's exploration, development, metallurgy, feasibility studies. These things all cost millions of dollars. So commodity prices driving decisions, not only by the incumbents, but the next wave of explorers and developers as well. You're right. That elastic band is going to be potentially stretched because of the pullback we're seeing, given where the commodity price is at. And also largely unrealistic expectations around incentive pricing by, some of the analysts out there.
But what about the quality of some of the material that's coming out of Africa?
Yeah, that's something, and it gets back to spend as well, where you're putting your dollars, because the quality, what we're seeing is largely, if you look at the metallurgical test work that was done on some of those assets, it was very much a smash and grab operation in response again to that all-time high lithium price, where every project makes sense, right? $8,000 a ton. So what you had was people going in an undisciplined way, looking to develop projects in Africa because they couldn't get the material out of Australia. But also there was very little technical due diligence done on those projects by way of metallurgical test programs, understanding the ore body and the characteristics of the mineralogy. So what we're seeing now is you don't know what you have until you drill and blast it. Is it spodumene? Is it lepidolite? Is it petalite? Is it some other lithium mineral? Or perhaps no lithium mineralization. To do a full suite metallurgical test program, which underpins your flow sheet, you need to spend at least 12 to 18 months. And you need to drill throughout the entire ore body to be able to generate that understanding, because ultimately, as you said, it flows through to recoveries. Your metallurgical test program will underpin your flow sheet and ultimately your cost base. So if you don't do the work, you don't get the results. Simple.
And also from our earlier calls, you mentioned you had recently visited China and some new converters. And what was your feedback from those visits?
The technology's impressive, world class from what I saw. But again, I talked about the procurement model in China being adjusted, and that's not just in lithium; that's in a whole range of industries. This, typically managing a 2 to 3 month inventory position of spodumene, chemicals, cathode, battery cells. What you've seen is a complete pullback in that to managing very, very smaller positions, because working capital is just as important it is in China as it is here in Australia, ultimately. So managing a significant inventory position, if you think the market is flat, it's unlikely to be profitable. So, but again, on the sentiment side of things, when that market turns and, the buyers think they can get a price or may face a higher price next week or next month, that's when you see the buying tend to ramp up and elevate, and that transfers to high pricing ultimately for raw materials.
But if you can, just comment on, to the extent that you can, your perception of what's going on, M&A, in WA and how it will unfold.
Yeah, sure. Yeah, I obviously can't comment on existing shareholders, but look, what I can say more broadly is that each company will have its own strategy as it relates to contracting, floor prices, pricing more broadly, contract terms, and then corresponding selling prices. You're talking about a couple of entities there, as you rightfully said, are well capitalized, well entrenched, have existing production assets, existing cash flows. The strategy there around, commercial contracting, very different to, a new producer or new developer that's trying to develop a greenfields project. So you will see quite significant variations, deviations in terms of each company's risk appetite in terms of taking on price floors and ceilings. But you're right, some companies will look at it, others won't. It makes sense for some companies, perhaps not, doesn't make sense for others. So, but look, last year was a pretty active, a very active year in terms of, M&A and equity positions more broadly within the West Australian industry. I think there's probably a realization that it's a great jurisdiction to be developing lithium projects, given the expertise that's here. I can talk about, the ecosystem of experience that we have here in Western Australia, and I'm sure Canada is looking to develop something similar. But also realization that, developing spodumene projects, hard rock spodumene projects in the state of Western Australia is generally, it happens a lot faster than other parts of the world. We've got the runs on the board. So clearly, if you look at the M&A cycle and how that plays out, then obviously putting investments into projects or industries that have the high chance of success makes perfect investment sense. So I'm not surprised by that. To answer the second part of your question, how does it play out going forward? Time will tell. We've seen price equity values of most of the really good projects come off quite significantly. Most companies are probably at 52-week lows in terms of share price. So it's a great opportunity to be buying, in my perfect sense, if you believe in the thematic. And let's face it. I was just going to say the consumers ultimately will decide, right? You can put out whatever product you want in the market, but it's the next wave of consumers that will decide where they put their money and how they buy products. And my personal view, it's going to be my kids making the decision. It's not you and I that are going to influence the market going forward in terms of our purchasing activities. It's going to be the next wave of consumers, and they're far more environmentally conscious than we were, and they're far more technologically advanced than we were. So an EV ticks both of those boxes.
Yeah, I want to agree with you on that, Ron. Look, I spoke to another analyst in Western Australia who's, my age, Rodney's age, in mid-50s, and he's, all the talk a few years ago of like the Gen Z, calling up on his phone, before he makes an EV purchase and says, "Where was this lithium bought?" That's a pipe dream, long-term future, and all of the worries of the auto OEMs. They're going to care, about, the sustainability and ESG, and, they're buying, dirty Indonesian, nickel, at the moment. And and they need low prices, right? It's hard enough for them to, make money from their high priced cars. So they're not rushing to pay, green premiums or so I like to believe that, but fundamentally your project and others in Western Australia is a very socially acceptable jurisdiction. That there's a thought like Ken Brinsden's moving to Quebec. He has an attitude of kind of go big or go home, right? Like the Rio Tintos and the BHPs, like something that could be like a mega mine that could support 100,000 tons, of hydroxide, capacity. The last cycle, and we had a bit of a the M&A distorted things last year. First Albemarle and Liontown, and then all that M&A activity in WA in the final quarter of the year, masked the lithium price, falling. And it just gave us, this impression strategics are taking this long-term view, then, it must be supportive of lithium equities. And clearly once the M&A stopped, and Albemarle is not going to make any M&A this year. If you listen to what their conference call last week, but a Rio could very well come in, right? Now would be a great time, for a Rio or BHP to come in. But when you think of a Rio, when you think of some of these players, they do think very big. So what does this mean? Like lithium has a lot of small, modest sized projects that are going to be second quartile. It would be great, find 1.3, 1.4, 1.5% large, 100 million tons with that characteristic. But the projects you're developing are smaller, and slightly lower grade, but nevertheless, infrastructure matters, jurisdiction matters. How do we think about, M&A possibility from big guys, or just what do you, and just sorry to keep going, like the prices are at 52-week lows. They are depressed. It's one thing. I think there is a short squeeze that is underway, and that will continue. We are going to get a rise in the lithium price, but, is it just going to rise to 1,000 or 1,250 and then level off, or is it going to go 2,000? Like at what level does like sentiment return and speculation comes into the market returns, and then the market cap of your company, reaches a level where the prospect of, raising the equity and debt capital you need is doable without massive dilution?
Yeah, that is a very tricky question to answer, and I don't have a crystal ball, so I won't try and find the exact sweet spot. I don't think I have the answer there. There's a lot needs to play out. But look, first part of your question more on scale. I mean, you got to look at it in the context of a lot of the exploration activity and the discoveries that have been made have really been in light of a very high lithium price that has encouraged, many projects to go and spin the drill bit to try and find lithium. So with most lithium discoveries, it does take you a while to build up your resource, to move from a 10 million ton, 20 million ton resource to a 50 plus million ton resource. It doesn't typically happen overnight. It does take a bit of time. And also, you need to also understand the complexities of building or developing approvals in some of these larger resources. The larger your project, the bigger the footprint, the more complex your approvals timelines can be. So there's that challenge as well. But my view is, I think you're going to see greater consolidation clearly for a number of the smaller projects. Is probably going to be a consolidation play at some point. I'm not quite sure where the pricing needs to be to really stimulate that activity. But as I said, what you're going to see for the first at least half of this year is a number of projects going to the holding pattern. We're pushing on. We're finding that perfect balance between discipline and protecting our balance sheet, and also pushing on the project, because it's important that as a company, if you believe in the thematic, that you're ready to go when the market does rebound. As to what price the market rebounds to this year, that's crystal ball stuff, Howard. I think you'd agree. If I had the answer to that, I probably wouldn't be doing my day job. But clearly it's at the floor. It probably punched through the bottom end on the floor price, in my personal view. And I think it's only upwards from here, but as to the order of magnitude of the market going up, time will tell.
Okay, Ron, thank you very much for joining Rockstock again. Hope to have you on later in the year to talk specifically about global lithium. But anyone who wants to know about global lithium, I'd recommend you go to the RIU presentation, which I think is on your website or on Twitter, and they could hear directly what you said there last week.
My pleasure.
Sayonara.
Thank you, Howard. Thanks, Rodney. Always great.